All right, warm welcome everybody to a brand new week ahead. Now, before we get started, just a quick disclaimer as always, none of the information that we share in this video should ever be taken as any type of financial advice, should ever be taken into consideration when you make your own financial decisions. Everything in this video is only general information only. This is my personal view of the market. It does not necessarily reflect the views of Fusion Markets, and Fusion Markets doesn't hold that any of the information that we share in here is accurate or complete, and you shouldn't rely upon any of the information in here to make financial decisions. Nothing that we share in this video should be taken as a solicitation to buy or sell any financial instruments. It's only general information. So, with that out of the way, there is quite a lot we need to talk about. Obviously, a lot of events occurred over the weekend. Now, for those of you who do not already know what happened, over the weekend, we had a series of strikes from the US and Israel against Iran. In retaliation, we've seen Iran striking multiple of its neighbors, targeting different countries like Qatar, like the UAE, like Dubai. There's been quite a lot of activity, and as a result, there's a couple of very obvious things that we expect from the markets at the open. Now, that is the easy part, right? Knowing how the markets are expected to react after these types of events, that is normally the first and the easiest thing to know. What we do not know, though, is what comes next, and that we'll talk about in a second. Let's first see how we're expecting the markets to react. Obviously, on the back of this type of geopolitical blowout that we've had and the uncertainty that comes with it, there's a couple of very obvious things that the markets would expect to happen at the open. There's expectations that we see a gap to the upside in things like gold. Obviously, whenever we have that geopolitical risk premiums increasing, that's normally a hedge that markets runs to for safety. So you tend to see gold upside in pure geopolitical risk off environments. And currently looking at weekend pricing, we're sitting somewhere between 54 and 5500 levels. So quite a decent pop there expected to the upside for something like gold. Furthermore, if you take a look at something like oil, this one is expected to see a very big gap. Currently, pricing sits around plus 13 to 14% higher. Now, that puts us around the 76, $77 per barrel level. So, a very big gap expected there to the upside. At the open as well. Similarly, we're expecting downside reactions for things like equities, with pricing for the likes of the Nasdaq trading around that 24,600, and for the S&P trading towards that 6,800 level. So that is the expectation that we would, or that is what we would expect to see at the open. Now, remember, that doesn't mean that you can get into a trade now and when the market's open, you take the benefit of that. Remember, your pending trade will be opened whenever or wherever the market opens. So there's no way of you trying to capitalize on these gaps after they have happened or when they happen. The market will open at those prices. So that's very important for you to always understand. So that's the easy part, right? Knowing how we expect the markets to react at the open, that's the easy part. Now, if you were lucky enough to be long things like gold or long things like oil or short things like equities coming into the weekend, then obviously you're going to open up with a decent profit, or should open up with some upside at least in those trades, and that's fantastic. What comes next, though? That is the tricky part, because we don't know what we don't know, right? There's so many different avenues that this geopolitical situation can take. Firstly, are these strikes that we've seen over the weekend, is this the end of it? Like, because remember last year we had a series of strikes again from the US and Israel against Iran with those nuclear sites that was targeted. But that entire thing was done within 2 days, right? We had a little bit of volley in terms of return fire, and everything calmed down fairly quickly. Now, if that happens again, then there is a likelihood that some of these gaps could actually be faded by the markets, right? If we get a solid confirmation that there isn't going to be any further escalation, or let's say the IRGC reaches some type of deal of some kind with the US, then there could be some fading opportunities to the downside in things like oil, or to the downside in things like gold, if the markets think that the worst is over. Because what you would expect to see at the open when things like this happen, if you take a look at things like implied volatility, you would expect implied volatility for things like gold, for things like oil, to rip to the upside. I mean, oil volatility was already trading at 65, at a 65 handle going into Friday. So you would expect to see a big blowout move there in volatility. You would expect to see a big move higher in volatility for things like gold as well. So if the market prices in a lot of fear, i.e., a lot of implied volatility going up, but then by the time that the markets realize that everything has calmed down, we could see a reversal in those volatility moves, which should theoretically see some reversal in those price moves as well. So that is a potential avenue that we can look at. But the tricky part with that is that we don't know. We don't know whether this is the end of it, right? We would need to see confirmation that, yes, this is the end of it. There is no further fighting. There's some type of deal reached, possible regime change, anything of those types of confirmations could be seen as possible mean reversion opportunities for these markets. However, what if we get further retaliation from Iran? What if they try to attack further ships in the Strait of Hormuz? There was news out just before I started this video of a ship being attacked by Iran in the Strait. Now, if that happens and we see traffic coming to a halt in the Strait of Hormuz, that completely changes the game in the short term. The markets will have to go through a whole series of price discovery, just like we saw in those first couple of weeks after Russia invaded Ukraine. The markets didn't really know how to price the risk accordingly. It took them a couple of weeks, but after they were able to price in that risk accordingly, then, after 2 or 3 months, the markets didn't even pay attention to that anymore, right? It was over fairly quickly from a market's point of view, at least. So in these next few weeks, if that escalation continues, if we see further attacks, if we see ships being shot at again, like we already saw, then yes, there could be further price discovery needed. Then the moves that we've seen at the open might continue if that's the case. But again, we don't know. We don't know what's going to happen. We can only guesstimate, and just be careful who you listen to as well, because whenever you have these types of situations, you have, social media is fantastic because it allows us to share a lot of information, right? There's information available today in social media that you would never have access to 10 or 20 years ago. Now, that's the good thing, but there's also a bad part with that, because it also means that you get access to a lot of bad information. And if you're not knowledgeable enough to know how these things work, that can land you in a lot of trouble. So, for example, be very, very careful when you listen to market calls about what's going to happen to oil, right? If you hear anybody telling you oil is going to go to $200 a barrel, I cannot tell you how much needs to happen on the geopolitical side to get us anywhere close to $200 per barrel. Is it possible? Yes, it's always possible. But geez, guys, the amount of stress and risk premium and brown stuff that needs to hit the fan for us to get there, that is a lot. So if somebody just comes out and says, oh, oil to 200, be very careful when you listen to people like that, because there's no way of us knowing. It's all speculation. If that is somebody's speculation, fine, but be very careful with who you lend your ears out to when it comes to these types of things. Oftentimes, and again, this is not any advice, this is just the way that I go about it. Oftentimes the best way to approach these things is with as sober of a approach as you can, right? Be open-minded, be sober when you think about these things, be realistic when you think about these things. Try and think about the upstream and downstream effects of these types of events, and not just, oh, oil to this price or gold to this price. We do not know, right? And that makes it very tricky, because if you get in at the wrong price for these types of things, right? So let's just say we see a huge gap to the upside in oil, 15% or 14% up, at least, is what the pre-market pricing is looking like. If we see that type of move, if you just jump in at the highs trying to trade it higher, you could make some money. But what if it opens and the markets have priced in adequate amount of risk premium, at least for now, and we just see a huge move down of 10% as the gap tries to be filled? You don't want to be the bag holder. And the problem with, lending your ears out to the wrong type of people is that you could end up being a bag holder when you absolutely do not want to. So just be very, very careful. We need more information, right? If you are lucky enough to be on the right side of the markets when this brown stuff hits the fan, well done. If you weren't, then you have to be exceptionally careful not to be a bag holder, because these environments, they tend to be very fluid. meaning that we could have massive escalation and de-escalation all in a time frame of like 5 to 10 minutes, right? You could have really bad news that hits the wires, and 5 minutes later you hear of a some type of deal or a negotiation that was reached. So just be very careful, protect yourself in these environments. Again, there's absolutely nothing wrong trying to take advantage of these volatile moves. That is what we as traders live for, right? We want to see this volatility. We want to see these big flows because there is the opportunity to make money, but you need to be very careful with it. You know, trading trading these things purely because somebody says they think oil prices will be this price or whatever, you need to be very careful with that. Think about it strategically. Don't be a gambler when it comes to these things, right? At the end of the day, you have to decide whether you are in this for the thrill of it, in which case it's basically just gambling and you're basically putting everything or red or black, or whether you actually want to make some money out of this in the long term, in which case you have to think about it a little bit more strategically. You have to think about it like a business, which means that you have to, you have to make sure that you're watching your six, you're being careful out there, and that's really what we want to where we need to focus on. So, in terms of overall reactions, again, what we would expect off the cuff on the back of this is we would expect to see upside in gold at the open, upside in oil, downside in equities. But again, trying to chase those things at the open, it's a little bit too spicy for me. It's a little bit too risky for me. I would prefer to just take things a little bit more patient, giving myself a little bit of time and waiting to see whether we get new information and where the markets think this thing goes next. Remember, these moves are volatile. It's volatile environments, and you need to be able to. You have to basically keep your head on a swivel, right? You have to be able to make decisions in a very short space of time if you're trading these types of themes. So the bottom line is we're expecting big moves. We could be seeing much bigger moves over the course of the next few days, but the bottom line is no one really knows. Unless you have insider information, of course. But if you are any other retail trader out there trying to make a profit out of these things, you need to be exceptionally careful. Right. So, without or apart from the geopolitical situation, we actually did have quite a few economic events to watch out for this week. Now, they are arguably not as exciting anymore because the geopolitical situation will definitely take that'll take the or get the brunt of the market's focus this week. But apart from the geopolitical situation, we do have a couple of economic data points, which is well worth keeping on the radar. On the US side, it is obviously the first week of a brand new month, which means that we get the next series of ISM data points, the ISM manufacturing coming up on Monday, the ISM services coming up on Thursday, and then we also get the US jobs report obviously coming up on Friday. Now, in terms of where we are from a pure policy point of view, the markets are still comfortable in pricing in two cuts by the end of this year. We can see that the first or the next cut is fully priced in by the July meeting, and then there is a second cut fully priced in by December. Now, given the variability with some of the economic data that we've seen recently, I guess that uncertainty still makes a lot of sense, right? Yes, we've had better than expected jobs data, but a lot of that has been concentrated in only one or two sectors within the economy, like healthcare, which means that yes, we had good data, but it wasn't exceptional because a lot of it can be explained away. Apart from that, apart from jobs data, we also had very good growth data for 2 3 quarters in a row, and then obviously we had that bit of a downside scare in GDP with the prior print. So we've had upside and downside in data, which means that the level of uncertainty warrants the markets pricing in still two cuts by the end of the year. However, if we were to see a massive deterioration or even improvement in that economic data, then obviously that changes things by quite a big margin, right? So this week will be important. Apart from like I said, the geopolitical situation, we've got a whole series of data points that'll feed into the market's expectations for either faster or more cuts or fewer and lesser cuts. So on Monday, we have the ISM manufacturing PMI, always one important to watch. Keep in mind, manufacturing is only about 20% of US GDP. It's not as important as Wednesday's ISM services PMI. This one is definitely more important, but both of these two very important inputs from a growth point of view. And remember, whenever we look at things like the PMI, it's not just the headline number that we focus on. That is the first focus point, but you always have to look at those subcomponents like prices paid. That is a very good input into inflation, right? Employment, a very good input into the jobs data coming up on Friday. New orders, a very good growth input. So you always have to watch and consider those sub indexes as well, apart from just the headline index. Then we also have ADP national employment. Now, again, a lot of people freak out about ADP, trying to trade ADP as a type of predictor of the NFP. Now, that is the last thing that ADP is. By the ADP's own admission, they do not try to predict where the BLS tries to land, right? By their own admission, they've said, hey, we don't try to give you a number that is close to the BLS, the non-farm payrolls number, basically. They only track real-time pay data in order to get us that jobs number. So there will always be big variance between the ADP and the NFP. But the reason why we still pay attention to it, even though it normally has a smaller reaction in the markets, the reason why we still pay attention to it is because it can impact expectations going into non-farm payrolls. Because remember, all of these forecasts, right? All of these forecasts that we get on a weekly basis. We get this normally on a Friday, Saturday, Sunday, sometimes a Monday for the week ahead. That means that all of these people that have put in their forecast for where they think NFP will land, they don't know what the ISM manufacturing employment will be, or ADP will be, or the ISM employment services will be. They don't know what any of these inputs are that feeds into this jobs data, right? And because they don't know what those things are, it means that this forecast can change throughout the week as we get new information coming in. So that means if we get all of these data points surprising massively to the downside throughout the week, it means that that 60 number might be a little bit high, which means the actual number might be a little bit lower, let's say 40 or 50. If all of these data points comes in super hot throughout the week, however, then that number might be a little bit low. So you always have to kind of adjust the forecast, or what you think the forecast will be, based on the incoming data that we get throughout the week. That's why these things are important. So yes, ADP, not something that forecasts where we think NFP will land, but it is something that can influence the expectations going into NFP. Now, in terms of market reactions, look, equities are going to be tricky because equities will be focused not just on the economic situation, but equities will obviously be focused on the geopolitical situation. So it makes trading equities out of the jobs numbers or any numbers we get from the US this week a little bit tricky, because you've got two counter narratives running right now. If the data is really, really good, that should be good because it means there's more earnings potential. It means the economy is doing okay, and that should be good for equities. The opposite side, though, if the data is really, really good and we start seeing the markets, pricing out some of those cuts that's priced in, that could be more negative for equities, and vice versa if the data is good or bad. So it's tricky for equities. I think the simplest way to be able to express any type of US data trades this week would simply be looking at trading something like the US dollar. The dollar is obviously expected to see a little bit of a gap to the upside on the back of the geopolitical situation. And we currently nudged between some pretty significant levels of resistance as well as support. We've got support coming in around that 97.30 level. We've got resistance coming in around the 98 psychological level. So those will be two key obvious areas that we'll need to look at for possible support and resistance. Breaking above that could potentially open up room for more upside in the dollar if the data comes in really good this week, and vice versa. If we do see bad data, breaking below that could open up the door for a move back down towards 96.50, and obviously to the upside we've got that 98.80 level as well. So I'm going to keep it simple when it comes to US data. I'll only be looking to trade the dollar. I think that's the simplest approach we can take for that data in the week ahead. Now, we've also got a couple of other data points that's worth watching and worth discussing. The first one would be the Aussie data. So let's just quickly get that on. We've got some GDP data coming up for Australia. Now, we've spoken about the Aussie multiple weeks now. If you take a look at the Aussie's performance, the Aussie has, in my opinion, adequately priced in a lot of the hikes that has been priced in for the RBA. Remember, currently, the RBA is a little bit of a standout compared to other central banks because they are, unlike the other banks who are either on hold or cutting rates at the moment, they are actually hiking rates at the moment, right? And we can see the next hike is almost fully priced in for that June meeting. So If we get really good growth data this week, that could see the markets pricing in a little bit more upside, but the market's already pricing in two hikes for this bank by the end of the year, which I don't think really changes that much if GDP data comes in better. If you take a look at, like we just looked at that chart, there's a lot of upside already priced in for the currency as well. And if you consider positioning on the institutional side, this market is crazy long the Aussie dollar. It's a very crowded position. That means I'm not really interested to trade the GDP data if we see a big beat. Even though that could see further upside for the Aussie dollar, I won't be interested to trade the Aussie dollar higher on the back of a beat. Because of positioning, I think the best case scenario for short term traders would be to see a massive miss, like well below the market's minimum expectations. And if we see that, we could use that miss as an purely as an opportunity to see some of this very crowded bullish positioning just trimmed back a little bit. Because remember, we don't need to see players suddenly going short the Aussie dollar to see the currency go down. At this level of positioning, we just need to see those people that are super, super long trimming their long positions, and that could force the currency lower anyway. So that is something definitely worth looking at as a potential a trade there, but only if the data comes in really, really bad. If it comes in really good, I'm just going to ignore it because I just don't see there's a lot of scope for real opportunities in that sense. Now, the other data point that we also have, which we just need to consider here, is Thursdays. Let me just quickly see where that is. Is it Thursday? Is it Wednesday? Let's just quickly take a look. We do have some CPI data coming up on Wednesday for Switzerland as well. Now, what makes this one tricky is it used to be a great indicator to trade the Swiss franc, but the Swiss franc has gone all geopolitical focus, which means that whether we get good or bad or low or high CPI data, it could have a marginal short term impact in the Swiss franc, but I doubt whether it would have any long term or sustainable reactions because geopolitics will be the big focus point. And apart from that, the S&B has previously told us that they would allow inflation to go a little bit into negative territory before they get frustrated. They still think that the medium term outlook for inflation is tilted to the upside, which means that they are basically blind to the deflation risks that is playing out in the economy. But at this stage, the main focus is really geopolitics for the Swiss franc. So even though that is coming up, it's something to be aware of, but it's not something that I think will provide us with any meaningful opportunities in the week ahead. So the big focus, firstly, like I said, will be geopolitics, seeing how those markets trade, watching your six in terms of gold, in terms of oil, in terms of equities, and then obviously watching those US data points throughout the week, the ISM manufacturing services, and obviously with that jobs data coming up on Friday as well. So quite a lot we need to focus on, quite a lot of excitement. I hope you guys will have a fantastic week ahead. Be careful out there with the geopolitical situation. And if there's any questions, as always, don't hesitate to reach out and let us know.